My T. Rowe Price covered call is deep in the money, more than $7 above my strike, but I'm continuing my strategy of monthly rolls. I try to roll up for a bit more breathing room, but with my cautious market outlook, I'm keeping my puts out of the money and my calls in the money. It's all part of a steady plan to reduce my overall loss with every trade. I've brought my loss down by more than $3,600 so far, and I'm looking forward to that December dividend. I'm going to start here with the covered call. It is in the money by about $7.50. If I can roll it out to January and raise the strike price, it would get me past the ex-dividend date. It would still be in the money, and I could potentially earn another $500 of capital gain. So I'm going to try that first. I will roll it up for any net credit. So I'm going to put in an order for, 25 cents a share. This is really unlikely to fill, and it looks like the price that's showing on Thinkorswim is a debit of about 50 cents a share, but I'll try one more time lowering my ask, and if I can't get it to fill, I'll just straight roll it out to November. If you are learning as you go, you're not alone. I built Saylor Financial Fundamentals to help new investors understand not just what I'm doing, but why. You'll find video walkthroughs, real trade logs, books, and resources to help you make confident, informed decisions without hype or oversimplification. All right, it looks like that's not happening. So I'm going to see if I can get $85. Now I'll do the same with the put, just a straight roll, keeping the same strike price of $95. Looking back at the contract that's expiring today, there are no bids to close the existing contract. It is almost certain to expire worthless at the end of the day, and I have enough cash in the account available to keep it covered just in the extremely unlikely event that the share price pulls back to 95 before the end of the trading day or after the market closes. So I'm going to cancel the roll and just sell a new $95 put expiring in November. I'll cancel this open order, and then I will just sell to open a new cash secured put that expires in November. I'm going to see if I can fill it at $1.15 a share. Now I'm going to check my filled orders. The covered call filled at $1.30 and the cash secured put filled at $1.28. I sold the cash secured put outright, so my trading fee is 66 cents, but I rolled the call, so I have trading fees for the closing order and the new opening order. These were both pretty good rolls with better annualized returns than I got for last month. So even though the share price has pulled back by about $5, I made more than $250 in options premium this month. I'll show that these are closed. And what I really like about this is how much the option premium and the dividend cushions the loss on the share price. I have 363 shares. So I've now brought my adjusted cost per share down to $102.58. The net liquidating value of the entire position is $36,143. And if I sum my expense and the net liquidating value, the overall position is still down almost $1,100. But I have improved it significantly from last March when I was down about $5,400. I'll roll these again on November 21st and look forward to receiving a dividend payment in December. No strategy is perfect, but this one keeps moving me in the right direction. I'm not trying to hit home runs, but I'm trading with a plan I understand, and every month I'm closing the gap. If that's the kind of approach you're looking for, I'd love to help you learn more. Check out my website or subscribe for future updates, and feel free to bring your questions. I'll see you in the next one.